I don't think COMEX will default. I think they'll change the rules to keep it from defaulting. They could force majeure, which is the same thing as a default, but I would assume they would still offer the service. Let's hope anyway, because if they did, we couldn't.
Yeah.
We saw about 1 million ounces leave COMEX and gold in the last 30 days. However, of all of these ounces that are standing for delivery, they are doing it in a very unusual way, standing for delivery instead of cash settling or rolling over and wanting numbered bars in their possession. Now, the next step would be to load out. We'll see how much loads out, but it's still, to me, these people are taking the extraordinary step of standing for delivery for this month already between 12 and $13 billion worth. That to me signals a whole lot more than the media isn't telling us anything about.
The precious metals market continues to attract attention as investors navigate economic uncertainty, rising debt levels, and growing questions about the stability of the global financial system. While short-term volatility has shaken confidence in some sectors, demand for physical gold and silver remains remarkably resilient. Large amounts of metal continue to move across international markets, suggesting that institutional buyers are positioning themselves for long-term changes rather than reacting to daily price fluctuations. Andy Schectman, a leading expert in precious metals and monetary history, believes that the most important developments are occurring beneath the surface of the paper markets. He points to the growing movement of physical metal away from Western exchanges and toward Asia, where demand remains exceptionally strong. According to this view, the current environment reflects a broader shift in global wealth preservation strategies as investors increasingly favor tangible assets over financial promises. If these trends continue, gold and silver could experience significantly higher valuations in the years ahead as physical supply becomes harder to secure. Now, we present the clips from Andy Schectman's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
December 2025, we set a single month record with 65 million ounces delivered of silver. January 2026 followed with 49.4 million ounces, more than 7 times January 2024 level. All of 2025 combined settled 474 million ounces, up from 203 million in 2024. February 2026 delivered 5,036 contracts. That's 25.1 million ounces, the highest February on record, making it the highest 2-month delivery rate in exchange history. 39 million ounces or 2.9 million pounds left COMEX in February, got on trucks and drove away. March of 2026 saw 10,526 contracts or 52.63 million ounces standing for delivery against 86.13 million ounces of registered inventory. June is still early with so far 2,181 contracts, with most of the month still ahead. The January to May of this year, 33,864 contracts or 169.3 million ounces delivered. And, you know, that's, again, we're only halfway through the year. If we take historically, the entire calendar year of 2023 saw only 23,414 COMEX contracts delivered. The January to May from this year, we're already at 33,864, 45% above the entire 2023 full year total in just 5 months. This is big. When we look at gold, February was the highest month at 40,711 contracts or 4.7 million ounces. June is already at 33,930 contracts times 100 ounces. You're talking almost 13 billion in gold, 13 billion in gold delivered in the first 10 days of this month. January to May 2026 total comes to 98,720 contracts or 9.87 million troy ounces of gold delivered so far this year. That's 45 billion in physical gold changing hands. And so when we look at the historical average for gold delivery months was around 15,000 contracts, with non-delivery months averaging 2 to 4. The entire year of 2023 saw 132,427 total delivered. The January to May this year, we're already at 98,720. We're almost the entire year of 2023. The point of it is that we're beginning to see a situation where there are entities that are preferring numbered bars over cash settlement. And that, to me, yes, people say, well, this is just moving back and forth. It's not leaving. We saw about 1 million ounces leave COMEX and gold in the last 30 days. However, of all of these ounces that are standing for delivery, they are doing it in a very unusual way, standing for delivery instead of cash settling or rolling over, and wanting numbered bars in their possession. Now, the next step would be to load out. We'll see how much loads out, but it's still, to me, these people are taking the extraordinary step of standing for delivery for this month already between 12 and $13 billion worth. That to me signals a whole lot more than the media isn't telling us anything about. When they leave the vaults or they're being sold, I think what he's talking about there, we see metal leaving vaults, so it could be ETFs being sold. The question is, who's taking the physical bars? Because the point of it is that you can get the primary distributors or the authorized participants of the ETFs. They can redeem their shares and stand for delivery instead of pulling it off the exchange. It's a way for them to gobble up available silver and gold when there is no real large availability available on COMEX, and do it in a way that doesn't get noticed. So, again, I don't know exactly the context that he's speaking of, but I would simply say to you that the physical deliveries, whether it be in Asia, whether it be here, or the metal coming off of the ETFs, which I believe is largely the authorized participants redeeming shares quietly, to me, again, can be viewed very bullish, not inversely. Some of it are people selling and bailing, sure, or redeploying it into SpaceX or whatever. But a lot of it, I think, is actually ways for these entities, not only if they're short on COMEX, they can redeem shares off of SLV and then move it to COMEX and apply it towards their short position, which then stands for delivery. So, the numbers are somewhat misleading. The numbers are somewhat
skewed, I guess.
Well, not only that, but they're also somewhat, I think, enlightening. It just depends upon the context, I guess, in which we're saying. But what is very unusual is the amount of metal that has been standing for delivery. I don't think COMEX will default. I think they'll change the rules to keep it from defaulting. They could force majeure, which is the same thing as a default, but I would assume they would still offer the service. Let's hope anyway, because if they did, we couldn't.
Yeah.
So you get that K-shaped economy where the very, very wealthy become much wealthier, a la the first trillionaire with Elon, and the rest of the people are struggling to make ends meet as AI and robotics and this type of technology really has its way with the job market. So on one end, yes, but if you were to put together the engine of manufacturing meshed with the ingenuity and the IT capacity of this country, now you're really dealing with something. You're cooking, right? But I think we have to do that for national security. Yeah. And we're at a point right now where the fact that we're so reliant on other countries, and we've already crossed the Ferguson law, which basically says that if you are spending more money on interest for your debt than you are on military, you will cease being a superpower. So we are at a threshold of national security issues where no one wants our treasuries. Our dollars are being inflated. We're paying more in interest than we are to protect our country, and we don't make anything. We have to do it. And I think this is the part that's always bothered me about everyone hating on Trump so much, because if he is doing this, the really hard part would have been that he couldn't tell anyone what he was doing until everything is ready to be told. And so he gets beaten up a lot over it. And part of it would be pushing countries away from wanting to use the dollar as the sole settlement system. So all of these rails, like we talked about today, the Chinese government just announced that they're ready to roll out mBridge, which is the cross-border digital payment system that is backed by China, Hong Kong, Thailand, United Arab Emirates, and Saudi Arabia. Mm-hmm. And so when you see these things happening, all of these things we've talked about seem to be manifesting, seem to be happening. And I don't know, to me, it's it wouldn't work just being the leader in AI and being reliant on everyone else for everything you need to run your economy rather than just your intellectual IT computer side of things.
A major focus remains the physical silver market and the flow of metal between global exchanges. Recent movements show significant amounts leaving Western vaults and entering Asian markets, particularly China and India. While many analysts closely monitor delivery statistics, the more important story may be where the metal ultimately ends up and who is accumulating it. The broader trend suggests that demand continues to outpace expectations despite periodic price corrections. Physical inventories may appear stable at times, but underlying consumption from industry, investment demand, and international accumulation continues to tighten available supply. If this pattern persists, silver could eventually enter a period in which buyers compete aggressively for limited physical inventory. Such a development would likely force prices higher and narrow the long-standing gap between paper valuations and real-world demand. This possibility continues to support a constructive long-term outlook for both silver and gold. Now, let's get back to the interview.
Economist, he's worked with Trump. He's a smart dude, and he was one of the economists who wrote a chapter in Project 25. You can Google Project 25, see what it's all about. But he wrote, I think, Chapter 24, where he advocates for issuing gold-backed treasuries. Now, I mean, I think it's very interesting that he would be the first advisor appointed. Let me read you actually what he says. He says, beyond full backing, alternate paths to gold backing might involve gold convertible treasury instruments or allowing a parallel gold standard to operate temporarily along the current fiat dollar. Now, I don't think they'll do that. I think they will do the treasury. These adoption while minimizing disruptions, but they could be temporary so that we can quickly enjoy the benefits of gold's ability to police government spending. In addition, Congress could simply allow individuals to use commodity-backed money without fully replacing the current system. Well, you're seeing states allow that right now, Texas and Florida, whatnot. But I think that, as Judy says, if you use gold backing on a treasury, it would act as kind of the guide, if you will, the sounding board. The alarm would go off if your monetary policy was too stupid, because gold would continue to march higher, higher, higher. So having it back the treasury would not be the same thing as a gold-backed system where monetary policy is restrained due to the amount of gold you have. This would allow you to do both. And she asked me, what do you think the odds of Trump announcing a 50-year treasury backed by gold, like Judy Shelton has told both her and I when we did podcasts? I did one with Judy, she did one with Judy. Both cases, Judy said, yeah, Trump told me he's going to issue gold-backed treasuries, more or less, on July 4th. I said it would make my day for sure.
Make your day. You might put on a red cape.
Yeah, I'm not going to sleep July 3rd. I said I might even drink all night and stay up waiting for the announcement. If it happens, it'll be the greatest call I ever made. And it will tell me that we are on the path to maybe restoring manufacturing and giving our kids a future. If you haven't heard my thesis by now, it's everywhere. You can go back and listen to it. I'm the only one stupid enough to say it, but I believe it. And if it happens, we'll know. And I said, but if it does, I said 50-50. And if it doesn't happen, I don't think it's end of story, but it would be amazing if he just got up there and said, you know, we're going to audit Fort Knox and maybe even tie something to a 50-year treasury in honoring of the 250th anniversary. Something that's simple would, I think, change the entire narrative for the rest of the year for you and I, what we would talk about. But she said, what do you think the odds are? I said 50-50. And you know, I hate doing that. And that's 10 weeks out, 3 weeks out.
So let's say that is the case. And let's say that Trump does make the announcement. Does that lead you to believe that there will be a quote unquote revaluation of metal?
See, that's why I don't think you need to revalue. And that's why Bassett came out and said, we're not going to revalue it. If you use Tether, who their CEO is Bo Hines now on USA Tether, who is Trump's cryptos are, wink, wink, nod, nod, you guys are going to buy gold. Well, who's been buying all the gold? Oh, that's right. It's Tether. They bought more gold since the last 2 years than anyone but Poland. Well, you guys buy the gold with the interest you can't transfer out of the Clarity Act. You're going to push the dollar down so we can pay off our debt easier and sell manufacturing to the world. You're going to push gold higher, which devalues the dollar, but then also would allow the convertibility on the treasury that you sell. By the time it gets out there 20, 30, 40, 50 years, the price of gold is way higher. And that's why Van Eck funds came out and said, if the dollar lost reserve status, gold could go to 139,000. That was the number they came up with. That's not me, that's Van Eck. So you sell a $20 million bond due in 20 years. Right now it's 4,500 ounces. At $139,000, it's 120 or 30 ounces. A whole lot easier. Not only could you have zero upfront borrowing costs when you sell those bonds to rebuild manufacturing, but the constant appreciation of gold, where it's from the synthetic demand for U.S. treasuries, but organically putting it into gold instead of the Fed doing it. By the way, as Tether does this and other institutions, maybe JP Morgan would do it, Wells Fargo, they'll all issue stable coins.
They'll all jump on board.
It allows the government to accumulate gold by proxy. So it's not in everyone's face. The U.S. government's not doing it, but they buy it quietly from Tether, from JP.
Yep.
And so they build their gold stack. The price of gold goes to the moon. The dollar falls, which enables us to pay off our debt, sell manufacturing, reshore manufacturing. And when we have to make good on those bonds in 20, 30, 50 years, it's a fraction of the amount of gold we would otherwise have to give up today. To me, it's elegant. It works. And I told her, yeah, 50-50, I think it happened. I also think a lot of the gold coming out of the ETFs are share redemptions by the big players trying to get gold without it, the light being shown upon them the way it would if it was coming out of COMEX. In other words, the authorized participants can redeem shares quietly for physical metal and then do what they want with it, like move it to COMEX to cover their short positions. But I think it's an interesting thought. If the peace deal has legs and we do see, for whatever reason, we acquiesce to the stupidity that we have to see an environment where the Fed can talk about lowering rates for gold to go higher, which is a bunch of nonsense. If we acquiesce to that, yeah, certainly we could. There's a big short position who thought gold, who thinks that gold has reached its top. And so they take the short side. And if they're wrong, very quickly, we saw silver move up $2 today, gold move up 130. Yeah, just like that, they get squeezed. They are one of the best in terms of information and analyzing the market out there. I wouldn't put it past them. I think it's a logical statement. We'll see what happens. If it were the managed money that was largely short, then absolutely, I would think that could happen. I think the managed money is kind of long right now. Could be wrong on that. Pretty sure I'm not. But the bottom line is that, yes, the logic behind it is sound.
The larger message emerging from the precious metals sector is that the market cannot be evaluated solely through futures contracts or short-term trading activity. Physical demand remains the foundation of long-term value, and there are growing indications that global buyers are steadily absorbing available supply. As more metal moves eastward and fewer investors are willing to part with their holdings, the market structure appears increasingly vulnerable to supply shocks. At the same time, concerns surrounding sovereign debt, currency debasement, and persistent inflation continue to strengthen the case for owning tangible assets. Gold remains the preferred monetary metal for central banks, while silver benefits from both monetary and industrial demand. This combination could create a powerful setup if economic conditions deteriorate or confidence in fiat currencies weakens further. Many investors view current volatility as a temporary phase within a much larger secular bull market. Looking ahead, continued physical accumulation, tightening inventories, and increasing geopolitical uncertainty could support substantially higher precious metals prices. Silver may outperform gold during the next major advance due to its smaller market size and supply constraints. If global demand continues to accelerate while available inventories shrink, the next stage of the bull market could unfold much faster than many expect. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.